One of the critical first steps in helping a business owner sell their business is to run a valuation. In other words, we need to come up with a price that the business can be marketed for to potential buyers. In this video, we'll walk through some basic definitions of price versus value and walk through the 6 basic steps of the business pricing process. Those 6 steps include collecting data, recasting the profit and loss statements, researching comparable transactions, computing the multiple, computing the price, or what we call the most probable selling price, and testing the conclusion. Before we get into the 6 steps of the basic business pricing process, we should probably first define a couple of key terms. First, let's define price. Price is the amount of some medium of exchange, oftentimes money, that is needed to acquire a business. Once stated, price is a fact, whether it's publicly disclosed or not. Value, on the other hand, is an opinion, not a fact. It's an estimate of an individual's perception of the anticipated benefits, recognizing both the risk of attainment and the time until receipt of those benefits. Now, those are formal definitions, but what does that really mean? What's the main difference between price and value? Well, simply stated, value is what the seller hopes to receive, and price is what is actually paid. As a professional business broker, it's my job to work with sellers to establish the value of the business based on historical performance and future expectations of the business. Before we get into the steps of the business pricing process, we should probably also define and explain what some of the different valuation methods are. When it comes to pricing or valuing a business, there are several methods that can be used. And the easiest way to remember it is AIM, A-I-M. The A is for the asset value approach, the I is for the income approach, and the M is for the market approach. The first valuation method you can use is the asset value approach. This is where you take the business assets and subtract out the business liabilities to get the asset value. As an example, if a business has $500,000 in assets and $100,000 in liabilities, the asset value approach would state that the business is worth $400,000. That would be the $500,000 in assets minus the $100,000 of liabilities. This is the worst valuation method if you want to sell your business as a going concern or an ongoing business. The second valuation method is the income approach. This approach is complicated and not relevant to small business owners. In short, you have to calculate the future economic benefit of the business, adjust for things like growth rate, taxes, and working capital, then discount the future value back to the present value. Frankly, it gives me a headache just talking about this particular valuation method. The third valuation method is the market approach. This method is most relevant for small business owners, and it's the method that I use. The basic idea is that we look at other businesses that are similar in size and nature to a seller's business and what they have sold for as a multiple of earnings. The value of your business is tied to the cash flow it produces or how profitable it is. The average multiple for a small business in the US ranges from about 2.25 to 2.5. I believe there are 6 key steps to pricing a business. Step number 1, data collection. As a business broker, we want to see what the buyer is going to see during due diligence. We don't want any surprises. That is why we collect both financial and operational data during the first step. Financial data will include things like 3 periods of profit and loss statements, adjustments related to those same periods, tax returns for the last 3 years, monthly sales for the last 3 years, and any inventory details if applicable. Operational data will include things like the age of the business, how many years the current owner has owned the business, employee details, whether it's a franchise or not, and any debt the seller will need to pay off at closing. Step number 2 is recasting. Most business owners have one key objective when it comes to taxes. That's minimize the profits and therefore the taxes for the owner. However, when the business owner wants to sell, one of the biggest values the broker, myself, brings to the transaction is to maximize the value of the business. In many cases, taxable profit or loss needs to be converted to seller's discretionary earnings, or SDE. This is the true net cash flow of the business, or the earning power of the business. Seller's discretionary earnings includes things like owner's W-2 wages, personal expenses, owner's benefits like retirement or health plans, interest income or expense, depreciation or other non-cash charges. All of these adjustments must be fully described and supported. Number 3 is comparable transactions. The basic idea is that we look at other businesses that are similar in size and nature to your business and what they have sold for as a multiple of earnings. According to industry data, the average multiple for most small businesses in the US ranges from 2.25 to 2.5. We have access to top industry databases that allow us to gather this information specific to your business and industry. Number 4 in the process is computing the multiple. Our valuation process includes computing a supportable multiple using not only past transaction data for your business's industry, but also through both quantitative and qualitative factors specific to your business. Quantitative factors would include things like the number of years the business has operated and the number of years you, as the business owner, have operated the business. Qualitative factors would include things like the amount of competition in your industry, specific industry trends, ease of replication of the business, or the amount of risk involved in running or operating this business. This combination of comparable transaction data and custom data allow us to arrive at the most accurate multiple possible. Step number 5 is actually computing the price. There are several different valuation approaches that brokers can use to value a business. The easiest way to remember these approaches is through the acronym AIM, A-I-M. Asset value approach. Number 2 is the income approach. The third approach is the market approach. Remember our earlier discussion about seller's discretionary earnings? Using the market approach, we take a weighted adjusted SDE for the past 3 years and multiply that by our market multiple to get a fair market value for your business. The final step, number 6, is testing the conclusion. And this is something a lot of brokers don't take the time to do. While not a hard and fast rule, we know that most buyers need to receive 3 things from the acquisition of a business. Number 1, they need sufficient cash flow to service the debt incurred in buying the business. Number 2, they need enough cash left over to support themselves and their family. Number 3, they need a decent cash-on-cash return. In other words, we want to be in the ballpark of the following metrics. Number 1, 20% annual ROI, and number 2, recoupment of their cash down payment within 24 to 30 months.